Alright guys, welcome back for another episode of the 30 Days to Better Trading series here. And last week what we talked, or yesterday I should say, or 2 days back, we talked about converting your dreams to math. And what that means is basically you come into the Forex market with a pipe dream or some type of reality that you want to experience, some type of dream you want to experience, make a reality. And getting to that end goal, you're listening to this video because you're not at that end goal. That's a fact. If you were there, you just wouldn't be looking at training. So you're looking for training because you're not to that point, and that's totally acceptable. I mean, it took me 3.5 years to be consistently profitable. So I'm not saying it's going to take that long for you. I'm just saying it's going to take some time. And one of the things that really helped me was having a perfectly clear picture of exactly what I wanted. And I talked about all this in the last video, so I'm not going to rehash it. But what that ultimately led to is, you get this great picture in your mind. You lay out a compounding chart. It helps you stay disciplined. Every time you want to revenge trade, overtrade, you look at that compounding chart. You look at what it leads to if you follow that plan, if you don't go off the rails. Because at the end of the day, and I've been educating at Day Trading Forex Live for 10 years. I started that business in 2010 teaching what I do. And in that time, as I always say, I've probably dealt with at least 100,000 traders. And I have never, maybe this has happened, but to my experience, I've never had somebody come to me and say, Sterling, I used a perfect 2% or 3% risk or 1% risk per trade, whatever it might be, whatever way they determine risk, and I wiped out my account. I did it 2% at a time and I wiped out my account. You guys know that's not how it happens, and I know it's not how it happens because that's not how I blew up my accounts. The way I blew up my accounts was in spectacular fashion. I might be able to consistently trade a strategy until things went wrong a little bit, but once you had a little bit of a drawdown, that's when the things that's when the bad habits start to come out. And you guys can all relate to that, I'm sure, which is obviously why you're here. So when it comes to strategy, though, which is what we're going to get into here, there's two types of strategies, right? In my opinion, there's reactive strategies, and then there's what I term as predictive strategies. By the way, guys, this desk, standing desk, if you don't have a standing desk, spend the $1,000 to get a standing desk. The cheapest place to get it from is thehumansolution.com. There's some other companies, they make the exact same desk. If you want to pay twice as much, you can go to those, but do your own research on it. Standing desk, though, the ticket. Anyway, so reactive versus predictive trading strategies. Now, in my opinion, I don't want to say all, but the vast majority of trading strategies will fall into one category. They're going to fall into, not the predictive strategy, they're going to fall into the reactive category. Not predictive category, I mean not strategy. So, they're going to fall into the reactive category. Well, what's the difference? Just as the basic word implies, if you were to look it up in the dictionary, reactive, you're reacting. That would imply that there's an action and you're reacting to something, whether it's an action, an emotion, or just something. You are reacting, you're reactive to an outside stimuli, right? So that's what most strategies do, and I'm going to illustrate that point. And then you have predictive strategies. They predict in advance, prior to the price action even showing it, that the market has the ability to turn here, could turn there. They're making their decisions in advance. It's preemptive. It's not based on actions in the market as reactive strategies are. So what does this mean? Well, let me go over to my next high-tech slide. And when you're talking about a reactive strategy, we'll start by just drawing, well, let's start with some blue here. But we'll start by drawing basically just an upward sloping market. So the market starts to rotate like this, right? The market starts to go up. Maybe you have a little bit of a pullback, then it starts to go up a little bit more. And a little bit pullback, starts to go up a little bit more. What happens along this route? Maybe this is over the course of, say, the distance in between these two is let's say 100 pips. So if you're talking a 100 pip rise from the bottom to the top of whatever rise it is, whatever pair you're looking at, that's not what I'm addressing here. If you're looking at that type of rise, what's occurring through that move? Are most retail strategies producing buy signals through that move, right? Or are they producing sell signals? So think about your own strategies for a second here. There's nothing complicated or you're not trying to trip anybody up with this question. It's just, what does your strategy do? Does it first see the market rise, and then it begins to trigger? Maybe some trigger down here. Maybe some trigger here, some trigger here, some trigger here. But the point is, you look at any indicator, MACD, stochastics, you look at, most of your trading strategies, chart patterns, price action, that's a big one. And I could go on and on with strategies. They're reactive. They first look at the market and they interpret market action, and then they react to market action. That's really another key I was getting at, should have got at earlier, and that is they react to the market action. In other words, they interpret this as the market truly rising. And yes, it is rising for this time period, but what we want to know is, what's it going to do next, right? Because the market begins to rise, maybe it rotates around over here. The point is, reactive strategies, and this is the main point I want you to get from this, reactive strategies, they react to the action in the market. They interpret market movement, either up or down, as intent of the market, truly wanting to go up or truly wanting to go down. They're just looking at the face value of the market. Well, what I term this as is, it's kind of like the Wizard of Oz. The Wizard of Oz. If you guys have never seen the Wizard of Oz, well, I don't know what the hellhole you're living in, but maybe outside the U.S. it's not popular. I don't know. But anyways, so when you look at the Wizard of Oz, they finally get to the wizard, and it's this big crazy thing. There's flames going everywhere, but it's really just this tiny guy that's behind a curtain, and he's making all this ruckus as if he was the great Wizard of Oz. So it's the same thing in trading. The charts are not there. You got to think about this. These brokers pay hundreds of thousands of dollars to access these charts, to have access to data feeds, and then they just give it to you for free. So why do they give it to you for free? Well, they know that a raw interpretation of the chart will produce, when the chart rises, it's going to produce, that action is going to produce the reaction of the majority of their traders are going to be buying into that rising market. The majority of traders, when the market falls, they're going to be selling into that falling market. That's just a basic principle of how retail traders follow a market. There's nothing complex about that. There's really nothing controversial about that as well. It's just a basic fact. Traders buy into rising markets. They try to sell into falling markets. The trouble comes in on a couple angles here. And the first angle is really how smart money trades, or how smart money has to trade. So you think about, for a second, we might come back to this, so I'll just flip it over. But you think about, for a second, how banks, or how the market functions in general. There are 10 banks, and you guys can look this number up on your own. You go to Wikipedia, or go to go to Google, type in Forex, and the first Wikipedia link, it's maybe 3-4 down, you'll find a Wikipedia link to the word Forex, or breaking down what the Forex market is. And down, if you scroll down maybe halfway, there'll be a chart of the 10 largest market participants. The 10 largest market participants control over 60% of the daily volume. So they control 60% of the daily volume. Let me ask you this. If you knew the individual, the institution that was controlling 60% of a specific stock, and you knew that they bought or sold on a Monday, would you want to know what they were doing? Would you want to find out whether they were buying or selling? What if you could preemptively find out whether they were going to buy or sell? Do you think that would benefit you at all if you could preemptively say, okay, they're going to be buying from here, they're going to be selling from here? Well, obviously the answer is yes. But for some reason, people don't take that idea and kind of apply it to the Forex market, or at least it's not commonly applied. This is an important point because we know that with this type of volume, they're going to have control. Now, I don't believe that smart money, banks, and anybody can control the market long term. I don't believe that. I believe in short-term market manipulation, short-term pops. I believe they drive the market into areas of liquidity, but I don't believe in long-term market manipulation. That's not what I'm referring to. It's not what I try to trade. It's not what I try to track. So I believe in short-term manipulation around key levels because it's really direct and short, something they can control very easily. But you think about this basic principle: if they control 60% of the daily volume, or if they're processing, that's the better way to say it, because banks don't make their money from speculative trading. That's the other myth. Banks make their money from commission, rollover. Rollover meaning people churning positions. So if there's 60% of the daily volume, and I'm sorry to go off on 100 tangents here, but if they're controlling 60% of the daily volume, then wouldn't it make sense that if they wanted to buy, they couldn't just simply fill all their buy orders at one point? They can't just say, well, you know, it came into the trading desk today, it got a crap ton of buy orders, crap ton of sell orders to get rid of and or to process, and you know what, I think we'll just go buy, sell. You know, it just doesn't work like that. They often will fill positions over 40, 50 pip ranges, depending on the size of it. They're going to trade against some clients. They're going to put some on the books. It's just, it varies so significantly. But the one thing that you know is they control a ton of volume. They're going to need a large amount of buyers if they want to sell, right? If you're controlling a major chunk, you need buyers if you want to sell. You also need sellers if you want to buy. Now, going back to what we just talked about here and identifying how the retail trader tends to trade this type of reactive strategy, if I know that the average retail trader is buying into a rising market, do you think it would be wise to assume that smart money and those that have the ability to influence short-term market direction also know what's going to get you to buy or what's going to get you to sell? Do you think that'd be a common sense statement? Well, I tend to believe it's a common sense statement. I don't think I'm smarter than they are. They have a lot more money than I do, a lot more time, a lot more everything. So I guarantee they also know this fact. As that market begins to rise, as they either allow or produce a short-term rise, what begins to happen? Retail traders begin to buy. Well, if they want to sell, if smart money wants to sell because they have such a large chunk of the market volume, they're going to start selling into this rise. Retail traders just bought from them, well, guess what? They're happy to sell to them. Happy to sell to them again because they ultimately know that the market is going to rotate down because they're going to put enough pressure on it. And the market's ultimately going to rotate to the downside. And then it becomes a self-fulfilling prophecy. All these people that were long, well, guess what? They have to short to sell that position back. And then smart money, which has sold into the original rise in the first place, as it gets fueled to the downside even more, well, guess what? They say, thank you very much for rotating that market over. We'll begin to buy our position back for a nice little tidy profit. So this process of creating an action in the market, they know they're going to get a reaction out of the average retail trader because the average retail trader has no idea about this. They have no idea that somebody's controlling the majority of the market volume. So you got to first get the fact that obviously they control that amount of volume. Number one, we've discussed that. We've discussed the fact that if you control that much volume, you're going to need buyers if you want to sell. You're going to need sellers if you want to buy. Then we discussed how the average retail trading strategy is reactive. It takes an action in the market and it interprets that action as if smart money was really buying or selling at that point. And you just don't know that. You just don't know that because you don't know what they're doing. A rising market does not mean the market's going to continue to rise. It doesn't mean smart money is buying. It just means the market happens to be rising for that period of time. So what we want to look at then, just logically, if banks control this much, if 10 banks control this much volume, process that much volume, be a better way to say that, but if they process that much volume, then wouldn't it be wise to identify where retail traders might be likely to be buying or might be likely to be selling? Because if you know where retail traders are buying or selling, then you probably know where smart money is going to be doing the opposite. If retail traders are buying, guess what? Smart money is probably going to sell. If retail traders are selling, they're probably buying into that selling pressure. So that's a reason why retail traders over and over again, I've had it said to me 1,000 times, Sterling, it seems like I enter the market at exactly the wrong time. That's not really a coincidence. It's not a coincidence because it's the way the market was designed. It's basic market function. They know an action is going to produce your reaction. When they get that reaction out of you, it allows them to sell into your buying pressure or buy into your selling pressure. So in the next video, we're going to talk a little bit about the selection of manipulation points. I don't have any real order I'm going with these videos. Honestly, guys, I had a bunch of camera equipment I bought about a year ago, never did anything with, and then I said, damn it all, I'm going to start doing a bunch of live videos. And it's just, I prefer this format. It's a little more natural for me. I'm used to talking to people, so it's just a little more natural. I can share a bit more information with you guys. I hope you like it, but I don't have an exact format. So hopefully it gets better with time. I'll get a little more precise with the videos and what I'm going to cover. But if you have something you want covered, if you have different aspects of the strategy you're not aware of, you want covered, different aspects of general ideology like money management, psychology tips, whatever it might be, feel free to leave a comment below. Let me know what you think. Let me know what you think of the video. And again, any feedback you have, and I'll take it into consideration. So I hope you enjoyed this video, guys. We'll be back for the next one that walks through the selection of manipulation points a little bit. That way we can start to identify where the majority of this volume might start to come into the market so that we can take advantage of it by doing what smart money is doing, selling into all the suckers that are buying or buying into all the suckers that are selling. So that's what we're going to go into the next video. I hope you enjoyed this one. I'll see you all back for the next live video. Until then, happy trading.